Hi, and welcome. My name is Guy Jones. I'm a local certified financial planner who's lived and worked in the Houston area for the last 25 years. I've been in the financial services business for the past 24 years, and I've had my own practice for the past 14 years. My specialty is retirement planning, and I've developed a particular expertise in tax-free retirement strategies. Today I want to talk with you about the discussion that you're not having in regards to your pre-tax retirement plan. Since pre-tax retirement plans came into existence, most, if not all, the discussion has been centered on the tax savings aspect of these plans. The discussion that I believe should be taking place is regarding the tax liability aspect of these plans. Let's start that discussion by taking a look at some different sources of retirement income. When you retire, all your money will be in one of two pots, either taxable or tax-free. If you could choose which pot to have the most money in, which one would you prefer, taxable or tax-free? We're going to look at the taxable side first. This pot can be divided into two different types of tax. The first kind is called capital gains tax. Some of the things that fall into this category are stocks, mutual funds, investment real estate, and the sale of a business. For those items, if you've owned them longer than 12 months, when you sell them, you currently only pay 15% on the profit. Now this rate has changed for some, which is now 20% for anyone in the 39.6% income tax bracket. The other side of this pot is something you are very familiar with, ordinary income tax. So let me ask you, do you think taxes are going to be higher or lower in the future? Personally, I think that taxes will be higher, either in the form of higher tax rates or by doing away with many of the current tax deductions that we now enjoy. I think there are a lot of reasons for that, and we've already seen the top tax rate go from 35% to 39.6%. So what falls into that category? First, any income you continue to earn, including 1099 interest. Second, even Social Security can now be subject to income tax. But most of the things that fall into that category are what I like to call the alphabet soup of retirement. IRA, SEP, Simple, 401k, 403b, or anything that's classified as a pre-tax retirement plan. When the money went into these accounts, you didn't pay tax on it. Thus, the idea that you're saving taxes, which you did at the time. However, when it comes out, all of it, both contributions and gains, will be taxed at current income tax rates. Now, let's look at what falls into the tax-free pot. There are three places that I'm aware of that you can put money and access it tax-free. The first one is municipal bonds. The second one is the Roth IRA. The third is certain types of life insurance. I tend to cross off municipal bonds for everyone for a few reasons. First, over time, municipal bonds have barely kept pace with inflation. Second, muni bonds by themselves are not very well diversified. And third, many municipalities are or on the verge of bankruptcy right now. For most people, you can contribute to both a Roth IRA and life insurance. But for some people, we have to cross off the Roth IRA because the government, in their infinite wisdom, has decided you make too much money and therefore don't qualify. So in their case, the only place that they're able to get money into the tax-free pot is life insurance. But it just so happens that's a really good option. There's a book on the market called Tax-Free Retirement. In it, the author has something he calls the Smart Investment Order. What that simply is the smartest order to invest your money. The first thing on this list, which really isn't an investment at all, is free money. Second thing is tax-free money. The third is tax-deferred money. And the fourth is taxable money. We'll skip free money for now because that's not really an investment at all. But would you agree that all things being equal, if you could get a tax-free return on your money, that would be better than just a tax-deferred return? And a tax-deferred return is better than a taxable one, right? So if you agree with the order of this list, let's look at each one of these in more detail. Free money. There are only two places I know that people can get free money. First is a gift or inheritance, and there aren't many people turning those down. Second is the matching contribution on a 401k. If you have a 401k that has a matching provision, then I'm going to encourage you to take full advantage of that because it's free money. However, if you contribute $1, even $1 more than the matching amount, then you've skipped from free money and gone to number 3, tax-deferred money, skipping over number 2 completely. So if number 2 is really better than number 3, let's take a closer look at that. The bar graph on the left represents the tax-deferred plan, and the one on the right represents the tax-free plan. As you can see, the money that goes into the tax-deferred plan, the contribution, has not been taxed. However, because the contribution hasn't been taxed going into the account, the entire account gets taxed at withdrawal. Everything, both contributions and gains. On the tax-free side, the money going in has been taxed. However, because it's been taxed going in, all of the money, every penny if done properly, can be accessed completely income tax free. So the only question you need to answer is, would you rather pay tax on this, or would you rather pay tax on this? So when you put your money into an IRA or 401k, are you really saving tax? No, you're simply delaying tax, which actually compounds the tax problem, making it worse. So where do we go from here? Here's what I'd like to do. If you'd like a free copy of Patrick Kelly's national best-selling book, Tax-Free Retirement, please email me at guypjones@guypjones.com or call me at 832-677-1692. This is a great book and clearly explains in much more detail how this strategy works and how you can apply it to your specific situation. But a couple of last thoughts before I close. First, it's very important to implement this strategy with someone who fully understands this concept from inception throughout the life of the plan. Second, if you felt this video was worthwhile and you know somebody who would benefit from viewing it, please feel free to share it with my compliments. Thanks so much for your time, and I look forward to hearing from you soon.